Welcome to the Chrisman Commentary Daily Mortgage News Podcast. I'm your host, Robbie Chrisman. Topics on today's episode include the loanDepot lawsuit and why originators should be interested, my interview with loan risk advisors Raymond Snytsheuvel on the state of fair lending in the mortgage industry in the wake of alleged Baltimore appraisal fraud and the aforementioned pending loanDepot litigation, and why would the Fed cut rates if the economy is doing well. Thanks to Jobless for sponsoring today's podcast. Jobless is transforming the mortgage industry with AI-powered data and analytics, featuring cutting-edge tools for automated indexing, income analysis, and discrepancy insights. Jobless is empowering underwriters to make timely, confident lending decisions. Whether you need to verify income across complex pay scenarios or review borrower documents with confidence, Jobless helps mortgage teams move at the speed of automation with the precision of human oversight. Learn more at oculus.com/mortgage. News broke this week of a case where loanDepot LLC is the defendant in this class action complaint filed in Maryland by attorney Ari Karen, head of litigation, labor and employment at Mitchell Sandler, on behalf of 4 named class members. According to the complaint, quote, "This is a class action arising from loanDepot's deployment of a sophisticated years-long scheme to systematically circumvent and conceal its willful violations of the loan officer compensation laws set forth in the Truth in Lending Act, for the purpose of obtaining a competitive advantage over other lenders and maximizing profits at the expense of plaintiffs and those similarly situated, all to enhance its financial performance in the months leading up to and following its initial IPO. loanDepot unlawfully steered plaintiffs and those similarly situated to loans with higher rates and fees and further created a system for the falsification of internal forms and federal disclosures to conceal these illegal activities. Loan officers were punished with reduced commission rates if they were unable to sell loans with higher rates, and further punished with no commission if they did not falsify internal documentation aimed at concealing the illegal activity. Since initiating the unlawful conduct alleged herein, loanDepot has originated over $300 billion in loans, all of which were affected by loanDepot's unlawful steering practices, in violation of TILA and potentially various criminal statutes, including wire fraud, securities fraud, false statements, and conspiracy, among others. Thus, a lender cannot link a reduction in compensation to some alternative factor that is merely a proxy for loan terms. So in this case, loanDepot could not use the sham transfer to an ILC as a justification for reduced compensation if the transfer was within the loan officer's control. This is why loanDepot required the completion of internal forms offering reasons for the transfer outside of the loan officer's control, such as customer request. Without these justifications explaining that the transfer was outside of the loan officer's control, the sham transfer would still be an insufficient basis to alter compensation. In other words, both the sham transfer and the falsified reasons for the transfer were essential to loanDepot's efforts to circumvent the loan officer compensation rules and conceal that there was an illegal variation of the loan officer's compensation based on loan terms." End quote. The case has captured the interest of originators and attorneys alike. Interestingly, I was unable to get any attorneys to comment on the record, and, one told me I could, quote, "not attribute the following." Quote, "I don't know and won't comment about the particulars of the facts alleged in application to law, but LOCOMP can have serious and expensive consequences, especially when applied on a class-wide basis. It is just surprising to me that a long-time respected mortgage industry attorney like Ari is representing class action plaintiffs on the opposite side of matters he regularly advises other lenders about." End quote. Originators were a bit more direct, but also desired anonymity. One said, "Mortgage bankers don't have to disclose their compensation, but brokers do. But brokers can switch to borrower paid and reduce their comp that way. Why shouldn't mortgage bankers be able to reduce their own comp?" End quote. Another chimed in with, quote, "There's no consumer harm from a consumer negotiating a lower rate that is paid from the LO's commission. That's the definition of a technical violation. Besides, CFPB recently said LO comp should be rescinded anyway." End quote. Something some found interesting was the level of detail in the complaint about the allegations of how loanDepot supposedly enabled these LO comp violations by lowering compensation and using different internal originators. That kind of operational detail is not normally available to consumers, who normally only know the final rate, fees, where to send their monthly payment, and the overall customer experience. For more information on this case, as well as the recent Baltimore appraisal fraud and kind of the state of fair lending in the mortgage industry in general, I wanted to welcome to the show Loan Risk Advisors, Raymond Snytsheuvel. He's a mortgage industry attorney with over 25 years of experience as in-house general counsel and compliance officer at the nation's leading mortgage companies. He's also been a loan officer and has hands-on experience in loan processing, underwriting, funding, customer service, internal audit, and providing legal representation that is informed by practical experience at all levels of a mortgage company.
There's a couple headlines out there, cases out there, events out there having to do with fair lending. I think we'll focus more on the loanDepot case than the appraisal fraud in Baltimore. And actually, let's start there. Can you give people a high-level overview of what the loanDepot case is all about and what's going on before we get into the implications and those other things? Set the stage a little bit for people, please.
Sure. In the fair lending case, in the loanDepot case, the fair lending implications, there was borrowers who were trying to get a loan on their home. I believe it was a refinance, and need to get their home appraised according to that course of practice. In that they suspected that the appraisal was lower than it should have been, and they then went on suspected and alleged that it was based on the fact that the borrowers were minority and that had an effect on the appraised value. To support their argument, they had another appraisal done. In that instance, they had, I guess they called it, cleaned out the property to show any signs of ethnicity, race, etc., and the appraisal came in higher. So the suggestion was that the appraiser who would come in appraised the home, and because the claiming causation issue, because the borrowers were minority, the appraisal was lower. Now, there's a lot of implications because it was in the minority neighborhood, et cetera. There's bigger issues here, but in essence, that's what it was. The suggestion was the appraisal came in low because they were minority, and they had evidence of that because the second appraisal did not come in low. So that's pretty much the basis of the claim. There's a lot into that, of course, but that's the basis of the claim.
And when we talk about these claims, I'm making a generality about a specific case here, but when these are brought up, is there generally, fire where there's smoke? Or do a lot of these end up being thrown out in court? Generally speaking, is there normally something there when it makes it this far into the news?
Wow. That's quite a loaded question.
Yeah, sorry.
Remember, we're talking about fair lending here, and as it's all good. And as we're talking about fair lending, and even the situation we're in, this is more fair lending from an academic perspective. I'm not going to talk quickly and what's happening administratively currently, et cetera, because things can change in 3 or 4 years. But the concept of fair lending, as we know, is a form of discrimination, whether some kind of a overt discrimination, could be disparate treatment, or maybe disparate impact. And again, current situations, administrations, how those interpreted and what they do might be different. But in concept, those claims would come up, not, I want to say often, but it's not unheard of. We get claims on fair lending, whether it's disparate impact or overt treatment, which if there's smoke, there's fire. That is hard to say. And I've been in this business a very long time. There's 3 sides to a story, 4 sides to a story if you're not careful. So we have to look and investigate for what these are. So I cannot say, let's put it in this context with the claim that we're talking about. Can we say there was discrimination? I don't know. I certainly don't have enough of the facts because a lot of it's not public. Everything's case by case, and we'd have to look at it very carefully. There's a lot of elements to come into to what is true and what is not. This is not to suggest the parties don't believe what they're stating or claiming. I can only tell you that we have to consider causation nexus. Was the appraiser, in fact, biased, either overtly or maybe implicitly he wasn't aware, or was, in fact, the other appraisal maybe it's the one that showed higher value? Maybe there was something wrong with that one. Again, I'm not here to suggest that the party is wrong. I'm not trying to stir things up, but I'm telling you, we don't know. Where there's smoke, there may be fire, or there may not be. I can rob you. I can tell you the legal answer. It depends. So it depends on the facts, ultimately.
There you go. I like that. What we're seeing out there right now with these couple of stories, what does it say about the state of fair lending or trends we're seeing in fair lending for the industry?
Well, we've had issues obviously before. We're talking originations, we're talking lending, you can be talking about brokering. And there's been an evolution to scrutinize now the appraisal process. Now, we know that, from 2008 forward and Dodd-Frank changes, appraisers have been allowed to be stepped back and be more independent because there were other suggestions about influence on appraisers in the past. But what I'm seeing now is in fact, as lenders would be, that we don't control the appraisers. We go to AMCs, but there might be a question. And from what I'm reading, what I'm seeing, what we've witnessed in the last few years, there's a little more scrutiny on the appraisal process itself and whether there are possible vulnerabilities as it relates to maybe either fraud, which might have implications, of course, in fair lending, or just straight out, as you mentioned, the loanDepot case, some kind of in the process there is some fair lending implications. And again, we don't control the appraisers as lenders. So that's what you have the AMCs for. We stepped back on the independence. So the question, and maybe sometimes the thought was, if appraisers are doing what they're doing, as far as we understand, an appraisal is nearly an exact science. I know it's not, but we suggest that it is because we know what comps are and how you come up with a value. We understand the process, so they should be coming up with objective figures and information to come up with a value. That's what we suspect. We're now seeing that maybe there might be other opportunities where there's vulnerabilities in the process, either unintentional or intentional, and maybe even as lenders, we need to keep a check on it despite the independence. But to answer your question, it does seem like the appraisal industry itself is falling into scrutiny as it relates to fair lending.
Yes, it's amazing how often the appraised price comes back at the same value as the purchase price, but that's a discussion for a different day. I guess the subsequent question, the one I asked would be, or natural subsequent question to the one I just asked would be, are there things that people in the mortgage industry are not getting about fair lending?
Well, I think fair lending can be perceived to be complicated. I will tell you that, and I've counseled clients and companies on fair lending over the decades, and the idea of fair lending in many cases, the simplicity of it is it's overt discrimination, and of course, no one should stand for that. Everyone understands that, including company leaders. It gets a little bit harder when you're looking at disparate treatment and how people are being treated, although it's not overt, but how they're being treated in the process. And that's harder to sometimes articulate, explain, to put an example for leaders of companies, how to identify it and then address it. And of course, we have the disparate impact issue, which is really putting policies in place that are benign on their face insofar as race, ethnicity, anything, but the effect is that it has a greater adverse effect and disproportionate effect on minorities. So when you start explaining this to people in the industry, and particularly lenders, it can get complicated very quickly. And my experience is it's not their lack of desire to understand or to be compliant. It's just that it is a moving target. It could be fluid. And so how to manage fair lending isn't always, as simple as training people to not say to say the right things and not say the wrong things. And it's a little bit more subtle than that. And so addition to that, you get anything from, as this is where we get the headlines, maybe a misunderstanding from the public as to what fair lending is and is not. And so we will have, and I've seen it many times, we will get claims of fair lending violations where many times there are not, when objectively you can show otherwise. But again, it gets into the dialogue very easily on both sides, on all sides for that matter, including regulatory. And it has a lot of teeth if you're not careful. It is not an easy concept to grasp all the time, especially at the loan level. And then we're dealing with regulators who might think otherwise, and maybe who think it's should be easier than it is.
I'm hoping you can speak a little bit to the evolution of fair lending, maybe a little less time on where it's come from to where it is now, but cases like this, how it will evolve into the future, how you see it progressing and moving forward.
Classically, we're talking about overt discrimination. So if you got somebody who's coming in and says, applying for a loan, it's like, well, we don't give loans to women. That's going to be a problem. That's overt discrimination. We know it. And of course, that should never happen. We see things about disparate treatment. We've talked about that in instance of you treat people differently based on race, ethnicity, something, and then with the policy issue. What we have seen really transition over the last several years is more the disparate impact issue. And as I mentioned before, disparate impact is not, the way I look at it, it's not a single instance. It's a policy that's set in place, that's benign on its face, it has a disproportionate effect on minorities. You can tell I've said this before. And so what does that mean? And I use the example often of minimum loan amounts. Can you do a minimum loan amount at a company? It's a management decision. And we can't do loans of less than 200,000, 100,000, et cetera. And the answer is yes, they could have fair lending implications. You have to be very specific about what your minimum loan amount will be and why. Again, if you look out on the face of it, it has no fair lending implications, but the effect is that it does. So we had the effects rule, if you will. Now, we know the administration currently has kind of put some of that on pause, but again, we're talking more academically here. So we've seen more of that evolution of a disparate impact, probably less than disparate treatment and certainly overt, I would hope. But now what we're seeing in the evolution is where are we finding the violations or the perceived or alleged violations. We've seen it with lenders, of course, always in the crosshairs, whether you're a bank or non-bank. And what we're now seeing the evolution, particularly with the appraisals, and as we talk about the loanDepot case, that's not the only one. I've personally been involved in other claims of appraisal discrimination, and we are now seeing that how the valuation of a property is derived was somehow done in a manner that included something that was not permissibly to be considered, whether it's the neighborhood, whether it's the owners of the property, and how that affects value, and of course the effect it's going to have on minorities. So we're seeing more of that. And the interesting there is we're seeing how that evolves. We have seen everything, last year the CFPB and other regulators coming about giving more scrutiny on appraisals and fair lending. There was, they were promoting, meaning the FFIEC and others were promoting ideas of putting into the ethics for professional appraisers that have more tones and issues related to fair lending and not to violate fair lending laws. So what we have seen recently is how it's coming into the appraisal arena. This is not to say that it's right, wrong, or different. I do wonder how often it's happening in appraisals. Again, appraisal being what I think is relatively objective insofar as how valuation is derived. But that's what we're seeing as an evolution. I mean, we still continue to probably see things in the process for lenders and brokers and others in the industry. But now it's actually moving into appraisers as well. And that's what I find interesting.
Certainly very interesting. And I'm glad I had you on the show to talk about this. Let me close with this. And obviously you're not here giving legal advice, but when it comes to best practices for compliance departments or lenders, people in the industry, what do you feel like are some things that might be being overlooked that companies could be better at when it comes to fair lending or disparate impact?
I think that's a good question. And I think, in fairness, I started in this business. I was a loan officer in this business to start with before I became an attorney. So, I was back in the 80s where we really had to do things, look at things. We didn't have automation. And sometimes I wonder if we, in the process that we do in manufacturing loans, trying to be efficient, time efficient, et cetera, I don't want to say we're taking shortcuts, but we're relying on things maybe too much. And in this instance, maybe we're not scrutinizing appraisals as much as we should in this process. I'm not suggesting lenders are not. I'm just saying maybe we should do more of it. We make the assumption with the appraisal independence that came in because of Dodd-Frank that we're not allowed to talk to appraisers. We have no influence on the appraisals. I understand that. But we maybe should be looking at the appraisals themselves to find out if the value makes sense. If we maybe look at these and find out, is there something in here that might have a sense of violation based on fair lending? It could be fraud, as we talked about other issues in Maryland, in Baltimore, as you know, could be fraud-based, and say these patterns do not make sense. The old school method of checking documentation and validating the information is correct and makes sense maybe has been lost a little bit in appraisals in the past at the lender side than before. And again, not trying to indict lenders for not doing the job. I'm just saying if you want to be more focused on this issue and then continue to make sure we do the right thing, maybe we should stop a little bit, take a look at the appraisals and see again, connect the dots to see if the value makes sense, the comments make sense, if the comps make sense to like we used to. And I'm not suggesting we don't do that. I'm just saying maybe we don't do it as much as we used to.
Well, maybe with the advent of some of this newfangled technology, it can help with some of this, picking up on anomalies and things of that nature. So maybe there's hope there. But yes, double checking is always good advice. I'm going to follow a good question with a bad question in closing here. And I will say anything that did I miss anything on this? Any closing remarks, kind of final words here about these cases?
Well, in the cases, if we talk about the recent Baltimore fraud case, that is truly, as alleged, is a fraud ring, and it was based on appraisals and inflating values. So that is, for lack of a better phrase, that's classic fraud, and we have to look out for that. In that instance, the implications there are maybe different than the loanDepot issues, but it still has an effect on the community. So in the Baltimore case, for example, one of the challenges we now have is we inflated values. Look, there are, and I've seen this happen, and I saw it. I was watching testimony for the CFPB at one point, and where the consumers raised their hand and said, "What are you guys doing to help me to afford a house in my neighborhood? All the LLCs and companies are buying homes. I can't afford it. What are you doing to help me for that?" And that's a darn good question. And the reason I said bring that up is because this particular case completely goes against that notion that we should make homes affordable, particularly in certain areas. So it's a little bit frustrating. So my point is, again, in that context, we should be cautious and probably be diligent in looking at appraisals for fraud. And again, especially ones that are affecting communities and the communities that need help most. If you look at the context of the loanDepot case, we're talking about appraisers who may or may not be biased. And if they are biased, it may be inherent, it might be explicit. The core understanding there is, I think we have to step back and not just assume appraisals are what they are, and we have to be a little more diligent to find out what the value is of the properties and scrutinize them a little more, like we did like we did in the old days. If we can use technology, going to your point, Robbie, I think it's a great idea. If you can use technology to find the anomalies, I'm not knocking that at all. I think it's an excellent idea, but we have to maybe do a little bit more. Is my point.
I agree wholeheartedly. I'm so glad we were connected. We were connected by Bob Simpson, who I've had on the show before. Very much enjoyed having him on. Enjoyed having you on immensely. So I appreciate the insights and looking forward to having you back again soon.
Thank you. I look forward to being back.
Nothing melts away the recent Trump-Powell spat-induced yield curve steepening like a batch of better-than-expected economic data. And that's exactly what happened yesterday. Data was highlighted by the June U.S. retail sales report, up 0.6% month over month, and weekly initial jobless claims report, down 7,000 week over week to 221,000. They were both solid in terms of their messaging for consumer spending and economic strength. However, retail sales figures are not inflation-adjusted and heavily skewed toward goods, raising the possibility that higher prices are boosting nominal spending while masking underlying weakness. The inflation data that was released this week showed that tariffs are beginning to filter into consumer prices, particularly in categories like toys and appliances. Or maybe CPI and PPI showed there's no noticeable headline uptick in inflation from tariffs. Interpret it however you like. Shrug emoji. While overall inflation remains moderate, signs of price pass-through from foreign exporters suggest that consumers may increasingly and ultimately bear the burden of trade tensions. New York Fed President Williams and Governor Kugler yesterday both signaled comfort with current policy, citing steady inflation and continued economic resilience as reasons to hold rates steady in the near term. Mortgage rates rose for the second straight week in the latest primary mortgage market survey from Freddie Mac. For the week ending July 17th, the 30 and 15-year mortgage rates rose 3 basis points and 6 basis points respectively to 6.75% and 5.92%, and are now just 2 basis points and 13 basis points lower than a year ago. Today's economic calendar kicked off with June housing starts, up 4.6% stronger than expected, and building permits. Expectations were for declines, so it's good news. Later today brings preliminary June Michigan sentiment. We begin Friday with agency CMBS prices slightly improved from Thursday's close, the 2-year yielding 3.88, and the 10-year yielding 4.43 after closing yesterday at 4.47%. Let's wrap up with a joke and some housekeeping. What do you call a guy with a rubber toe? Roberto. What about a guy with a rubber toe who has lost his car? Roberto Carlos. I think I can say that joke because my name is Roberto Carlos. Thanks again to Ocrolus for sponsoring today's podcast. Ocrolus is transforming the mortgage industry with AI-powered data and analytics, featuring cutting-edge tools for automated indexing, income analysis, and discrepancy insights that empower underwriters to make timely, confident lending decisions. To learn more, visit ocrolus.com.